Passive funds are eating into the market share of active funds, and we have to address this by maintaining a focus on delivering performance that cannot be achieved by index funds, both in terms of absolute performance and in downside protection.
We are currently in an exciting market environment characterized by turbulence and uncertainty. Today I'm speaking to Edward Guinness, Chief Executive of Guinness Global Investors, about how to position yourself as an active fund manager, active asset manager in the current environment and where the challenges currently lie. Hello Edward, lovely to have you here.
Guten Tag. Thank you very much for having me.
Guinness Global Investors is an independent active fund manager focusing on long-only equity funds. Would you say the current market environment is particularly suited to active fund managers?
Well, over the last 15 years, markets have been great for investors with a long-term perspective, and our funds are managed with that long-term perspective. There's been material turbulence on the way, so being invested in a fund where investors can be confident in the underlying philosophy and process is important, as is having high-caliber fund managers. Our Global Equity Income Fund is specifically designed to navigate choppy waters and has done so consistently. It has done so by only investing in companies with low leverage and more than 10% cash flow return on investment every year for 10 years. This has also been a stock picker's market, where the performance has come from a narrow range of stocks, and being in the right stocks rather than just the broad market has been a critical factor in outperforming. For example, our Global Innovation Fund has had consistent top decile performance in the highly competitive growth fund sector, despite structurally low ownership of the Magnificent Seven. Our funds have an equally weighted approach, with typically 30 or 35 stocks in each portfolio. This is differentiated from the weighting approach of most indices, which are often market cap weighted, and is well suited for active management, as we are continuously looking for our best 30 ideas rather than adjusting weights between ideas. Anything that improves fund manager efficiency like that helps deliver outperformance.
You spoke about managing the cycles and risk management. What are the biggest challenges for active fund managers at the moment?
The rise of passive funds is an inexorable trend. Europe is behind the US, but catching up. Passive funds are eating into the market share of active funds, and we have to address this by maintaining a focus on delivering performance that cannot be achieved by index funds, both in terms of absolute performance and in downside protection. Passive funds are putting pressure on pricing as well. We have to make sure we're able to offer funds at competitive prices so that we win as much of the active fund market share as possible. We aim to be top decile with our pricing versus our active peer group. The regulatory environment is also a major challenge. We're dealing with a lot of new regulations in multiple jurisdictions. Once you understand what the regulator is looking for, compliance is typically straightforward. But achieving that understanding takes up a lot of senior management time. The last point is investor aggregation. As more wealth managers and banks come together via mergers, that pushes prices lower and means there's less scope for innovative, differentiated funds.
I'd like to pick up on the index funds and ETFs in just a minute, but let's talk about Germany for a second, because Germany seems to be a very exciting market for a lot of asset managers from all around the world. How tough is it as a British asset manager to grow in the German market, especially with all this competition around?
I think I would pick on three things. First, culturally, we find we're quite well suited to it. I studied German at school and spent time living in Germany. We have a German-based German head of German sales, and our overall head of sales has lived in Germany and speaks German. We therefore think we're able to understand the drivers culturally of operating in Germany. Germany is familiar to us. Second, as you say, competition in Germany is high, but as a British fund manager, we offer a global skill set and a global perspective to investors that is hard for German domiciled managers to replicate. Third, we have a very structured process. We have 35 equally weighted stocks in each portfolio, and our universes are constructed from stocks that have A, persistent long-term historic cash flow return on investment, and B, high leverage. That creates a quickly communicable approach that resonates in the German market, where investors like things that are alles in Ordnung. Fourth, I'd say fund domicile. Our strategies are all offered as Dublin domiciled funds and are therefore directly available for German investors.
So lastly, let's talk about the index funds and ETF, because you just recently launched your own active ETF. How important is it to have such a new type of business? And also, does it cannibalize your existing active strategies?
We have taken on managing our first European ETF this year as a manifestation of our sustainable energy strategy. And we think there is a big opportunity for active fund managers to participate in the ETF space. Investors are likely to move towards ETFs over time, and we think there is much more scope for innovation from the ETF structure. At the moment, we see it as another channel to market, but as the market evolves, I would expect to launch products specifically aimed at ETF investors. As an aside, we were the first firm in the US ever to convert a 40-Act mutual fund to an ETF. We've been managing ETFs in the US for a number of years and have gained good experience. We don't think of this as cannibalizing our strategies. Clearly, there are going to be investors for whom an ETF structure is more attractive, and we will now be able to address those. The digitization of ETFs makes them accessible on platforms where UCITS funds aren't available. There are two benefits that may, however, drive switching. First, real-time pricing rather than end-of-day pricing. And second, a lower withholding tax rate, where US dividends have a withholding tax of only 15% in Dublin.
Therefore, the ETF business can be crucial for the growth of an active manager and be a new channel to market, says Edward Guinness. Thank you very much for your insights.
Thank you.